Hello, welcome back to the course on capital budgeting. So far, we have covered the different investment decision rules such as net present value, payback period, and IRR, and understood how we calculate them. What are the implications of these three different rules? And when do we use these rules? And what are the parameters for accepting or rejecting project under these? However, they works very well for a very simple way of doing things. But how do we choose between two different projects, which may be different in size or different in nature? For that, we're gonna use a couple of examples to explain how do we choose between two different projects. So the choosing between two different projects means the project need to be mutually exclusive, right? So that we can calculate the project from those, we can choose those projects. You cannot just pick the project with the positive NPV because you have their projects are mutually exclusive. They are not related to each other. You need to choose the project which ranks the highest, which gives you the highest NPV. So you need to calculate the highest NPV, but if the projects are different in size, you normally need to calculate the profitability index, which we're going to explain later. Now let's first look at the process to calculate different same investment but different options. So you are given an example here that you have a small piece of commercial land. You have a choice to either buy it, sell it for 220,000, or you can do something by yourself where you will have a bar, a coffee shop, and an apparel store. Then you can eventually leave that for your business. So if you have some information like this, what would you do? So you have a choice to take 220,000 now and leave it, or you make an investment of 400,000 and the cash flow in the first year is 60,000, growth rate is 3.5%, and cost of capital is 12%. Coffee shop 200,000, cash flow in the first year is 40,000, and then growth rate of 3% and cost of capital in 10%. Apparel store, same way. First thing you need to understand in this problem is you are given a the initial investment amount is different, and the cash flow cost of capital is different for each project. Why is that? Because the projects are different, they are not same, the risk in each project is different. So that's why the cost of capital for all the projects is different. So because based on the inherent risk, based on the expected cost of capital. Another thing you will see here is we don't have the cash flow for let's say second year, third year, fourth year, but instead we are given a growth rate. So in that case, when we are calculating the net present value or the of the cash flows, assuming that the business will continue for a very long period of time, the formula will be different. Formula is cash flow divided by cost of capital minus rate of growth. So cost of cash flow divide by bracket in the brackets rate of growth minus the rate of capital minus the rate of growth. So higher the rate of growth, higher will be the value. Lower the cost of capital, higher will be the value. So in the first case, the net present value will be calculated as 60,000 divided by 12 minus 3.5, i.e. 8.5%. So you can calculate that on your formula. We have calculated that. So there is a formula for you to see on the screen. You can note down that formula, and then NPV will be CF1 divided by R minus G minus initial investment. So once you calculate these three different options, the NPV are 305,000, coffee shop 370,000, apparel store 250,000, and your own sell the land is you're gonna get 220,000. So definitely selling the land is not a choice because you are getting only 220,000. Opening up the coffee shop is the highest option. However, the investment in coffee shop is 400,000. So you need to see, do I have 400,000 or not? Or can I borrow the money at lower than 12%, which is which is the at which the present value is already giving us the higher value. If you don't have, then you may not be able to choose that option. Then you will go to the, sorry, coffee shop, and then you will go to the second option. Coffee shop here is giving you the highest NPV because they have a lower initial investment and the cash flow is decent. Plus the cost of capital and the risk in the coffee shop is lower than compared to bar and apparel store, understandably. So this is how you choose between the mutually exclusive projects which are not related to each other, but they are competing with the same amount of money. Right. Then even though so that now we look at the difference in scale. So the difference in scale at 10% of IRR, you can see that, you can read that it will have a different IRR, different value impact on 1 million and 100 million. So scale matters. I will explain to you this concept with the help of an example. So let's say Maria has two different options for her boyfriend's business. One is invest into boyfriend business, which is $10,000, and then she get a return of 6,000 each. So her NPV will be 4,400. Either she invest in her own delivery business, where she gonna get an NPV of $2,000. So here the choice is simple. She need to invest in her boyfriend's business. But what if Maria can invest a bit more and get a higher NPV? So her IRR at the moment is 36% of investing into her boyfriend business. Now, if let's say Maria says, now I can invest in 10 drones for the business, which means the setup cost will be 25,000, but the outflows will be 25,000. Here you will see the NPV is $10,000 now. Even though it's better than the boyfriend business, how will the Maria make a decision? Because the investment here is not 10,000, is not the same. It's 15,000, which is higher than your initial investment in her own business in the initial time, or her boyfriend's business. So how do you make the decision? In these kind of situations, we calculate a crossover point, means at what rate the decision between the two will be irrelevant. So how do we do that? In the current situation, IRR is going to be 23% in this project. Now the IRR in the boyfriend's business is higher, remember, 36%, as we saw. Here is 23%. So definitely you should choose a boyfriend business, but the IRR is not going to give you the money, is because it's a percentage, right? The however is the amount of money, it will remain, it may not change that much. So what we do basically is we calculate the three different options, as you can see here on the graph, that you have her own business with the two drones, and her boyfriend business, and then you calculate the NPV profile of 10 drone business, which is her new business with a higher investment. And then you, once wherever they are crossing, you will get it a crossover point. So the crossover point here is 20%. Since the cost of capital for Maria is 12% and the crossover point is 20%, it's better for her to invest in her own business rather than invest in the boyfriend's business. If the cost of capital was higher than the crossover point, then it would be worthwhile to invest in her boyfriend's business rather than in her own business. So that's how we make a decision between two different size projects. How do, apart from the graph, how do we calculate? Yes, so the calculating the crossover situation is to make a crossover point where the NPV between two different options, her business at the lower level and her business at the in higher investment, is same. So in this case, her own business is minus 50, her higher business is minus 15,000, 25,000, 25,000, 25,000, and her boyfriend's business is 10,000, 6,6,6,000. So by solving these two, we get minus 40,000, 19,000, 19,000, 19,000. So now the equation you will see is seems like same as your IRR. So here you will solve it for IRR. You have already learned how to calculate the IRR. So if you calculate this, the IRR will come to 20%. right? 20.4%, which we 20.04%, which we saw in the NPV graph as well. Now, which decision you will make? Since the cost of capital is lower than the IRR here, we will choose the incremental NPV at this rate is going to be benefiting the her own business, because her cost of capital is only 12%, but the crossover means that in difference to make a decision is 20%. So she'll be choosing her own project in the business. Another example to explain the crossover point here is project A and project B have different initial investments slightly and different initial cash flows. If you calculate the same way as we have calculated earlier, combining the NPVs difference between the NPV of two projects should be at 0. So we get this situation. So we get this initial investment minus 2000 and 900. Here you will be calculating the crossover point, which means you are going to get 16.6%. But if your cost of capital is lower than 16, then you will accept the first project. If it's higher, then you will accept the second project.